Forecasting economic trends is one of the most tempting and most misunderstood activities in investing. The temptation comes from the belief that if you can see the future even slightly earlier than others, you gain control, confidence, and advantage. The misunderstanding lies in what forecasting is actually capable of delivering. Many investors approach economic forecasting as prediction, expecting clear answers about growth, inflation, recessions, or market direction. In reality, forecasting is not about certainty. It is about probability management. Used correctly, it sharpens awareness and prepares portfolios. Used incorrectly, it creates false confidence and costly overreaction. At its core, economic forecasting is the attempt to interpret signals about where an economy may be heading over time. These signals come from data, behavior, policy, and structure. None of them speak clearly on their own. Each is noisy, lagged, revised, and influenced by incentives. This is why economic forecasts are often wrong in detail, but useful in direction. Investors who expect precision are disappointed. Investors who expect context are better served. The first mistake investors make is believing that forecasting means calling turning points. Recessions, recoveries, inflation spikes, and policy shifts are usually recognized clearly only after they are underway. Data confirms what behavior has already started to change. By the time a recession is official, markets have often moved significantly. Forecasting, therefore, is not about ringing bells at tops or bottoms. It is about recognizing conditions that increase or decrease the likelihood of certain outcomes. Economic indicators are often divided into leading coincident and lagging indicators, and understanding this distinction matters more than memorizing specific data points. Leading indicators such as yield curves, purchasing manager surveys, or credit conditions hint at future activity. Coincident indicators like employment levels or industrial production describe the present. Lagging indicators such as unemployment duration or inflation persistence confirm what has already happened. Investors who react to lagging indicators as if they were forecasts often act too late. Another common error is focusing on single indicators in isolation. Economies are complex systems. No single data point tells the full story. Inflation can rise while growth slows. Employment can remain strong while leading indicators deteriorate. Forecasting requires assembling a mosaic rather than following a headline. This is uncomfortable because mosaics rarely point in one clean direction. They require judgment, not obedience. Policy interpretation is another critical component. Fiscal and monetary policy shape economic outcomes, but not always in the way investors expect. Central banks react to data. They do not control it perfectly. Governments respond to political incentives as much as economic ones. Forecasting that assumes smooth, rational policy responses often fails when confronted with real-world constraints. Understanding reaction functions, how policymakers tend to behave under pressure, is often more useful than predicting specific actions. Behavioral signals are frequently overlooked in economic forecasting. Consumer confidence, business sentiment, hiring intentions, and credit appetite often change before hard data does. These shifts reflect expectations, not outcomes, but expectations drive decisions. When households and firms become cautious simultaneously, economic momentum slows, regardless of what last quarter's data says. Forecasting that ignores behavior misses the engine of change. Structural forces operate beneath cyclical noise. Demographics, productivity trends, debt levels, energy systems, and technological adoption shape the range of possible economic outcomes over decades. These forces do not predict next quarter's GDP, but they constrain what is plausible over time. Investors who anchor forecasts in structural realities are less likely to be surprised by slow-moving but powerful trends. One of the most dangerous habits in forecasting is overconfidence in narratives. Stories make sense of complexity, but they also oversimplify. A compelling narrative can cause investors to ignore contradictory evidence. Economic forecasting must remain flexible. When new data consistently conflicts with a forecast, the forecast should change. Defending a forecast is an ego game, not an investment discipline. It is also important to recognize the limits of forecasting for portfolio decisions. Forecasts should inform ranges and tilts, not binary bets. The future rarely unfolds exactly as expected. Portfolios built on a single macro view are fragile. Portfolios that incorporate multiple scenarios are resilient. Forecasting is a tool for preparation, not a license for conviction. The best forecasters are often the least dramatic. They speak in probabilities, not absolutes. They update views gradually rather than flip positions suddenly. They understand that being approximately right consistently is far more valuable than being precisely right occasionally. This mindset aligns forecasting with long-term investing rather than short-term speculation. As data becomes more abundant and commentary more confident, the challenge is not access to forecasting tools, but discernment in using them. Knowing which indicators matter, how to interpret them without overreacting, and how to integrate forecasts into portfolio decisions without letting them dominate behavior, is where most investors struggle, because forecasting should reduce surprise, not increase activity. And learning how to apply economic forecasting as a stabilizing input rather than a trigger for constant change is exactly where we need to go next. By examining how to use economic forecasting tools and techniques with discipline rather than drama, because tools only add value when they are embedded in a clear decision framework. The first practical tool is indicator grouping. Instead of reacting to individual data releases, group indicators by theme: growth, inflation, liquidity, and sentiment. Within each group, watch for directional consistency. One weak data point means little. Multiple indicators moving together over time means something is changing. This approach filters noise and reduces the impulse to overtrade on headlines. A second essential technique is trend analysis over levels. Economic data is often revised and lagged. Absolute numbers can mislead. Trends reveal momentum. Is growth accelerating or decelerating? Is inflation broadening or narrowing? Are financial conditions easing or tightening? Direction matters more than magnitude. Investors who focus on trends adjust expectations gradually instead of swinging between optimism and pessimism. The yield curve and credit spreads are classic forecasting tools for a reason. They compress complex expectations about growth, inflation, and risk into market prices. While not perfect timers, they often signal stress before it appears in headline data. The mistake is treating them as triggers. Their value lies in highlighting vulnerability, not in dictating immediate action. When financial conditions tighten persistently, portfolios should be reviewed for resilience, not flipped overnight. Policy reaction functions form another critical lens. Instead of forecasting exact rate moves or fiscal packages, focus on constraints. What outcomes would force policymakers to act? What trade-offs are they likely to prioritize? This perspective reduces surprise. When you understand how policymakers tend to respond under pressure, their actions feel less chaotic, and forecasts become less brittle. Behavioral and survey-based indicators add context that hard data misses. Purchasing manager indices, consumer confidence, and business sentiment often shift before spending and hiring do. These indicators are imperfect, but when they align with financial conditions, they strengthen the signal. Forecasting improves when behavior confirms data rather than contradicts it. Scenario analysis is where forecasting becomes truly useful for investors. Instead of one forecast, build a few plausible scenarios and ask how the portfolio would behave in each. What happens if growth slows, but inflation remains sticky? If rates fall quickly, if policy tightens longer than expected? This exercise does not require precision. It requires honesty. Portfolios prepared for multiple outcomes outperform those built on a single view. The most important technique is forecast humility. Update views incrementally. Admit uncertainty. Reduce position sizes when conviction is high, but evidence is mixed. Increase diversification when signals conflict. Forecasting should slow decision-making, not accelerate it. When forecasting increases urgency, it is being misused. In the end, economic forecasting is best understood as a risk awareness tool. It does not tell you what will happen. It helps you avoid being blindsided by what could happen. Investors who master forecasting rarely look heroic in the moment. They look calm when others are surprised. If this discussion helped you see forecasting as preparation rather than prediction, consider subscribing to stay with these long-form conversations that emphasize judgment over certainty. And leave a comment sharing which economic indicator you pay too much attention to, because recognizing that habit is often the first step toward using forecasts more wisely.